अरे yes. Yes, everyone. First, can you let me know is the video, audio, everything is fine or not so that we can start our live class? Everyone, just respond fast. Video, audio quality is good or not? Everything is perfect? Very good. But what I am finding that everyone has not joined the live class. I don't know why you are not joining the live class. Today for YouTube, it will be the last session in the YouTube. So even if you are listening the class in YouTube, I have already requested everyone to join the CJ Academy app for the live class. From tomorrow, there will be no live class in YouTube. And if you have registered for live classes until now you have not started watching the classes, so let me inform you that live classes will be end immediately after 10 minutes of our live class. Means you can't listen the live class once the live session is over. Then you need to listen your live batch from your backup, and we are providing 50% of backup hour. Means if the total hour is 150 hours, then you will be provided 75 hour to 80 hour for backup hour. Then you need to consume that backup hour to listen your classes. Okay, got this point? To live classes will be ended immediately after 10 minutes or 20 minutes of the live session. Okay, got this point? Are you able to understand whatever I am saying? Okay, very good morning everyone. How are you all? Everyone fine? Super, very good. Okay, the last class we completed our India's 37. Today we are going to start a new chapter, that is India's 10 even after reporting date. So if you have any doubt in India's 37, that you can ask me. One doubt already asked, that is question number, one doubt is question 34. Very good question and important also. come to that question number 34. Actually, normally I take this example in the class. This time I have not taken this example in the class. Might be reason that you have a doubt in this. Okay, but okay, even though I am not taking the example, you are going to read the questions. You are going to read the question. Okay, under new legislation, an entity is required to fit a smoke filter to the factory by 30th September 2001. 30th September 2001 date is very much important. The entity is not fitted the smoke filter. Entity is not yet fitted the smoke filter. It is assumed that reliable estimation can be made of any outflow expected. Means for the future expenditure of fitting the smoke filter, they can reliably estimate the amount. Determine whether any provision is required to made by the entity on 31st March 2001. So, can I say entity is required to fit the smoke filter to his factory by 30th September 2001. 30th September 2001, so of course, can I say for 31st March 2001, there is no obligating event. There is no obligating event. So, of course, no provision is recognized for this. Why? Because there is no obligation, because there is no obligating event either for the cost of fitting smoke filter or for any fines. Just try to understand, if suppose there is a legal obligation to fit smoke filter, so there can be some penalty or fine if they are not fitting the smoke filter. Now, as on 31st March 2002, whether they are required to create provision. So just try to understand, this fitting of smoke filter is actually dependent on future conduct of business. Means it can be avoidable. Are you getting? It can be avoidable. Why it is avoidable? Just try to understand. It is quite possible that management may decide to change the production method, and if they change the production method, then there can be a possible reason that now there is no need to fit the smoke filter, or they can close down the business also. Are you able to understand? In that case, it is totally dependent upon future conduct of business. Hence, for this year and also, no provision is required. Understood? So there is no obligation for the cost of fitting smoke filter because no obligating event. No obligating event has occurred. No obligating event has occurred means what? For the fitting of the filters. No obligating event for the fitting of the folder. Doubt is what? Why they are saying no obligating event? Why they are saying no obligating event? I think this is the doubt. However, an obligation might arise to pay penalty or fine under the legislation because the obligating event has occurred. So just try to, for fine and penalty, yes, obligating event may arise because by the end of 30th September 2001, if you are not fitted, there can be a possible fine or penalty. For that reason, there is an obligating event. Okay. Now, obligating event means what? Obligating event means what? Any past transaction which gives rise to obligation on reporting date, that is an obligating event. So can you say in this case there is a past event, but that is not giving rise to any obligation on reporting date, hence there is no obligating event. Hence there is no obligating event. So you can say there is no obligating event. There is no doubt about this. I think you need to understand what is the meaning of obligating event. Obligating event means due to any past transaction, there must be obligation by the end of reporting period. So of course, in this case, because it depends upon future conduct of business, so you can see there is no obligation. There is no obligation, and therefore they have written that there is no obligating event. Chalega? Okay, sir. Any doubt? No any doubt? Chalo. Now let us come to our new chapter. New chapter is what? Ind AS 10. Ind AS 10, very simple. Why it is very simple? Because this is the only one accounting standard which you have understood in your CA. Am I right or not? Accounting standard 4. Very simple. Let us start the Ind AS 10 event after reporting date. Now, what is the meaning of event after reporting date? Means suppose this is the balance sheet date or reporting date, whatever you want to say, and this is our reporting period. This is our reporting period. So the question is that for any event which occur after balance sheet date, whether the financial statement of this reporting period require any adjustment. So our Ind AS 10 say yes, it require adjustment if there is an event occurring after balance sheet date. So what is the meaning of event occurring after balance sheet date? Any event which occur after reporting period but before approval of financial statement. Who approve our financial statement? Can I say the financial statement is approved by board of directors, not by shareholders. Are you getting? So first, the financial statement is approved by board of directors. So once it is approved by board of directors, then can I say there cannot be any amendment, yeah, any changes in the financial statement which has been approved. Got this point? It means, can I say, practically what happened? We first prepare a draft financial statement of the reporting period. As on 31st March, we prepare the draft financial statement. Then can I say it will be audited by any chartered accountant, correct? And then it will be presented to the board of directors for their approval. Once board of directors has approved it, after audit, then there cannot be any changes in the audited and approved financial statement. And therefore, just try to understand, there can be some event occurring after balance sheet date, which is after balance sheet date but before approval of financial statement, that might be adjusted in the financial statement of given reporting period. Got this point? Now we need to understand what are that event which require adjustment and what are that event which do not require any adjustment. Means, can you say Ind AS 10 is not applicable for any event which arise after approval of financial statement. Means any event which arise after approval of financial statement is not relevant for this chapter. This is not relevant for this chapter, even though it may relate to what our reporting period, even though that event may relate to this reporting period. So we are only concerned by which event which occur after reporting period but before approval of financial statement. Before approval of financial statement. Got this point? Yes, sir. So what is the meaning of event after reporting date? Which are any event which are those events which may be favorable or it may be unfavorable. Means this event may be favorable to the entity or unfavorable to the entity. Favorable means it will give rise to gain. Unfavorable means it may give rise to loss. So it may be favorable or unfavorable to the entity, and which occur between reporting date and the date when the financial statement are approved for the issue. Approved for the issue means that financial statement is approved by board of director. Okay, sir. Now just try to understand practically what happens once it is approved by board of director. Then it will be presented to the shareholder in annual general meeting for further approval. For further approval means in annual general meeting it will be approved by the shareholders of the company. So this approval is not at all relevant. Not at all relevant for this chapter. Are you getting what I am saying? Of course, can I say once any financial statement is approved by board of director, it will be presented to the shareholder in annual general meeting for further approval. But approval of shareholders is not at all relevant for this particular chapter. Therefore, some clarification has been given on the date of approval. Some clarification has been given on the date of approval. From this clarification, MCQ question can be asked. Multiple choice question can be asked. What is the first clarification they have given? If the financial statement are to be approved by shareholders, after financial statement are approved by board of director, financial statement are approved for issue on the date of approval by board of director. Understood? Why? Very simple. Second, one more clarification. If financial statement are issued to the supervisory board means of non-executive director for approval after management approval. Management approval means approval of board of directors. Sometimes what happens, suppose company has taken a loan of 500 crore from bank. So bank will appoint their officer and they will constitute a supervisory board. So once it is approved by board of director, it must be approved by the supervisory board consisting of non-executive director. Can I say their approval is also not relevant? Their approval is also not relevant. Understood? One clarification has been given. In this case also, financial statement are approved for this chapter for issue when management approve financial statement. Means approval of supervisory board is not at all relevant for this particular chapter. One more clarification has been given. This I need to explain. Just try to understand what actually happened, that any company may prepare quarterly financial statement. Quarterly financial statement will do one more Ind AS 34 coming soon in your life, where we prepare interim finance report Q1, Q2, Q3 and Q4. Are you getting what I am saying? Are you able to understand? So this become reporting date. This become reporting date. Now what happened? This is the financial statement. This is the interim financial statement of quarter 1. This is the interim financial statement of quarter 2. This is the interim financial statement of quarter 3. This is the interim financial statement of quarter 4. So this also require approval. So can you say this will be approved somewhere यहाँ पर, this will be approved somewhere यहाँ पर, this will be approved somewhere यहाँ पर, and this will be approved somewhere यहाँ पर. Are you getting what I am saying? Correct? Are you able to understand? Once entire quarterly results are approved, it means, can I say this, the information is now public, means this information of the total profit is now with the public. That you understood, because this will be also published, this will be also published. Means, can I say at this point of time, at this point of time, total profit information is with the public. Now just try to understand, for annual financial statement, one board of directors meeting will be held for annual financial statement. So annual financial statement is different from interim financial statement. The question is that whether annual financial statement can be different from the total of interim financial statement, means whether if suppose any event occur at this point of time, whether it can be adjusted in the annual financial statement even though it is not adjusted in the interim financial statement. So answer is yes. It means, can I say, even though the profit information is available to the public, then also, can I say, interim financial statement is not at all relevant. We need to think about annual financial statement right now, and for that, the date of approval will be the date of approval when the management has approved that financial statement, annual financial statement. Got this point? This point is clear. Now you will be able to understand. If financial statement are approved by board of director after public announcement of profit, or other financial information, financial statement are approved for issue on the date of approval by the board of director. Understood? ABC clear? ABC clear? Now there is one special point. Try to understand. Now normally what happens? Suppose this is the reporting date. This is the date of approval by board of director. Date of approval by board of directors. Correct. Sometimes some special power is given to some of the officer or some of the owner of the company that they can reopen the books of account if there is some fraud, in the company. Got this point? It is quite possible that there was some fraud in the company which has been investigated by some of the owner of the company. So they have a right to reopen the books of account. Even though the financial statement has been approved. So they have a right to reopen the books of account. So can you say, if the fraud was investigated, the books of account can be reopened. And can you say, once again financial statement will be prepared because there was a fraud. The fraud will be investigated and that will be also require adjustment. So once again financial statement will be prepared, and once again, can you see, there will be board of directors meeting. So can you see, this is the date of approval of the amended financial statement. So in this case, what is the date of approval? So date of approval will be this date of approval, not this date of approval. Got this point? I hope it is clear. Understood? So that has been given. If the financial statement were reopened for further adjustment subsequent to initial approval, the date of approval should be taken as the date on which financial statement are finally approved by the board of directors. Very, very important. Can be asking multiple choice question. Got this point? There are some reference question given. Can you read by your own? Because my help is not required. Once you know the content, you can do by your own. This is what the event after reporting date. Clear? Any doubt? So can I repeat once again? Event after reporting date are those events which can be favorable or unfavorable and which occur between reporting date and the date when the financial statement are approved for the issue. Correct. Now, from accounting treatment point of view, these events are of two types. One is adjusting event. Everyone know, because AS4 you are aware about AS4, and second is non-adjusting event. So what are adjusting event? Any event which provide evidence of the condition existing on the balance sheet date. Means any event which provide evidence of the condition existing on the balance sheet date, that is known as adjusting event. So what India stance says that if that event provide evidence of the condition existing on the balance sheet date, then that event should be adjusted in the current financial statement, and therefore it is known as adjusting event. So adjustment means what? Can I say adjustment means we need to pass one adjustment entry. We need to pass one adjustment entry. So whenever we adjust that event in our financial statement, it means, can I say asset or liability will be adjusted and corresponding income or expense will be adjusted. Corresponding income or expense will be adjusted. With that adjustment entry, our asset or liability and corresponding income or expenses will be adjusted. Got this point? So what is non-adjusting event? If the event relate to any condition after balance sheet date, after reporting date, then it is not an adjusting event. Means there can be two type of event. One event which relate to the condition existing on the balance sheet date. One event which relate to the condition arising after balance sheet date. So if the event relate to the condition arising after balance sheet date, can you see that is not relevant for this financial year, and therefore that does not require any adjustment. But what our Indian states say that if the amount is material, then we should disclose the fact in the notes to account. Then disclosure is required if the amount is material. So which relate to the condition arising after reporting date, no adjustment required. Disclosure of such event is required in the financial statement, that is notes to account, if the amount is material. Super easy. Super easy. Now what I will do, I will take some example to understand whether you are aware about AS4 or not. More or less AS4 and India's 10 is 99% same. Only there is one special point in this chapter which I should discuss. Got this point? So what I will do, I will take some examples. I will take some example of CA inter level and धीरे I will go to CA final level. चलेगा? Okay, sir. What you are supposed to do, you need to just mention whether it is adjusting event or non-adjusting event. If your answer is correct, thank you very much, smiley. If your answer is not correct, then you just give star mark in that example. Because if right now you are doing mistake, in exam also there will mistake, you will not revise. Normally what happens, whatever we have done in CA inter, that only we carry forward till CA final exam. So we need to understand, yes, the logic behind that is this, and now the correct answer is this. Okay, sir. So you need to respond for whatever example I am drafting at this moment. Chalega, are you all ready? Yes, sir. Let us come to example number 1. Whatever example I am writing, you also write. Even though you feel you don't want to write, you write it. Okay, sir, but fast. You should write down all the example with me, because I will not give any time, any extra time for writing. Chalega? Yes, sir. So suppose this is reporting date, example number 1 we are doing, and this is the date of approval. And there is one debtor. If you remember, every time any faculty in CA Inter will start with an example of debtor only. I don't know why. But because in CA Inter every faculty start with debtor, I am also starting with debtor. And somehow we feel that India's 10 is for debtor only. Am I right or not? But India's 10 is for all asset, all liability. Got this point? Yes, sir. Now, let's say Mr. X, amount receivable is 10 lakh, and he is a good debtor. He is a good debtor. Good debtor means nice person. Correct? Now what happened? After reporting date and before approval of financial statement, fire occurred in Mr. X factory and he become insolvent. He become insolvent and now no amount is recoverable. No amount recoverable. बताओ adjusting non adjusting, you need to be थोड़ा सा fast. Adjusting non adjusting, fast. It is an adjusting event, non-adjusting event. So I am getting the answer adjusting event, but it is a non-adjusting event. Understood? The first example, you have given wrong answer. I don't know why you have given wrong answer, but just try to understand what you have done in CA Inter. CA Inter, this is one of the common example, but if you are saying adjusting event means somewhere is wrong, somewhere is wrong. Are you getting? But many people have said non-adjusting event. It is a non-adjusting event. Non-adjusting event, because just try to understand the condition. This condition arises after reporting period. So there is no condition of default existing on reporting date, and therefore it is a non-adjusting event. Chalega. Okay, example number 1 done. Can we come to example number 2? Example number 2. Read example number 2. The student who are giving wrong answer need to understand and write down yes, now it become non-adjusting event, and give a star mark in this example. 31st March, this is date of approval. Once again, there is one debtor, let's say Mr. X, of rupees 10 lakh, and he is a doubtful debtor. Doubtful debtor means what? Suppose the credit period was allowed, was 2 months, and 2 months has been expired, and till now the collection, the amount is not recovered. Means he is not saying that he will not pay. This Mr. X is not saying that he will not pay. He is saying yes, I will pay, but he is not paying. So he become doubtful. So whenever I am saying doubtful, it means there is no evidence for any loss. So whenever I am saying doubtful, it means there is no evidence of actual loss. This type of loss is known as impairment loss. So any decline in the value of asset is known as impairment loss. New term in your life, write down impairment loss. Then you will automatically understand why it is known as impairment loss. There is no evidence of actual impairment loss, and therefore we call it doubtful. If there is an evidence of impairment loss, then it becomes bad debt. Then it becomes bad debtor. Correct? So if there is an evidence of impairment loss, so at this point of time, because he is now insolvent, there is an evidence of impairment loss, but that arises after balance sheet date. Got this point? Yes, sir. Correct. So, but he is a doubtful debtor. Now what happened? Before approval of financial statement, he was declared insolvent. So very much clear. Now you only say it is an adjusting or non-adjusting event fast. Adjusting, non-adjusting. It is an adjusting event, non-adjusting event fast. Yes, very good. It will be an adjusting event. Why it is an adjusting event? Because it relates to the condition existing on the balance sheet date. It provides evidence of the condition. So there was a condition on 31st March. There is a condition of default. There is a condition of default. Let me give you what is the objective of Ind AS 10 as well as AS4. Try to understand whenever we prepare draft financial statement on 31st March. So of course, can I say there is a condition? There is a condition existing for the default because he is a doubtful debtor. So based on our respective Ind AS, means we recognize impairment loss on debtor as per Ind AS 109. So this impairment loss is recognized as per Ind AS 109 coming soon in your life. So can we'll apply Ind AS 109. We'll apply Ind AS 109, and based on whatever information is available on 31st March, we'll recognize allowance for bad and doubtful debt. And suppose we have recognized 2 lakh and this become 8 lakh. So this is in draft finance statement. Correct, as per the information available on 31st March. But before approval of financial statement, we found that the loss is not 2 lakh, the loss is 10 lakh because he now become insolvent and no amount is recoverable. No amount recoverable. Are you getting? So if before approval of financial statement, we know that if no amount is recoverable, so you only say what is the fair amount, what is the fair view of the financial statement. We should report debtor at 8 lakh or we should report debtor at nil amount. Yes, nil amount, because just try to understand before approval of financial statement, it is now confirmed that loss is not 2 lakh, loss is what? 10 lakh. So this, because it was an estimation, it was an estimated amount. So if we got some information about that estimation and we got a correct estimation or it is near to actual information, then of course we should prepare our financial statement based on that event, not based on the information which was available on 31st March. Got this point? And therefore it become an adjusting event. Therefore it become adjusting event. What adjustment is required? We need to increase allowance for bad and doubtful debt by rupees 8 lakh. By rupees 8 lakh. Understood? Any doubt? So it become an adjusting event. Try to understand what I said. What is the adjustment required? We need to increase the amount of allowance, but we are not passing bad debt journal entry. Bad debt journal entry will be done on the actual date of bad debt. Means bad debt will be recognized in the next financial year. Abhi on 31st March he was a doubtful debtor, so we need to only recognize allowance for bad and doubtful debt, and we need to increase the amount of allowance for bad and doubtful debt. Understood? So bad debt journal entry will be done in the next financial year. Means in 31st March, what journal entry we are doing? Profit and loss account, debit to allowance for bad and doubtful debt. Now it become 10 lakh. In the next financial year, suppose this is 31st March 2026. 31st March 2026. In the next financial year 26-27, will pass journal entry bad debt account debit to debtor 10 lakh, and then this bad debt will be adjusted with the allowance whatever we have created, and the next journal entry will be allowance for bad and doubtful debt to bad debt, that is 10 lakh. So this is our adjusting journal entry. This is our adjusted journal entry. Adjusted. Why adjusted? Because 2 lakh already we created. Means this is 2 lakh plus 8 lakh. Huh? This is 2 lakh plus 8 lakh. Understood? This point you understood? Yes, sir. Let us come to the next example. Example number 3. This is 31st March. This is the date of approval. And there was a debtor. An amount recoverable, या receivable was 10 lakh. And already we created a allowance for bad and doubtful debt. Already we create an allowance for bad and doubtful debt amounting to rupees 2 lakh. That is 8 lakh. Correct? But what happened? Before approval of financial statement, Entire amount is collected. Entire amount is collected. Quite possible. Means before 31st March, he was actually doubtful debtor, and we are of the view that amount might not be recovered. But before approval of financial statement, he came to us and he has paid entire amount. You only say adjusting or non-adjusting event. Apply your common sense. Now don't apply whatever you have done in C enter, because I know what you have done in C enter. Apply your common sense as a chartered accountant. What is a fair view of financial statement? What information you should give to the user of financial statement as per fair view? But the adjusting or non-adjusting fast. Very good. Adjusting event. Understood. Adjusting event. It is also an adjusting event. Correct. Yes. Why? Because can I say it also relate to the condition existing on the balance sheet date? Condition was there is a default, but there is no default. There is no default. Hence, it relates to the condition existing on the balance sheet date. And can I say entire allowance will be reversed? Will be reversed. So we need to reverse the allowance for 2 lakh, whatever we have created. Chalega? Yes, sir. Got this point? Suppose after my explanation you are not able to understand, you can just raise your hand and ask the doubt whatever you have not understood. Okay? Chalega? Example. But if you are not asking the doubt, I will assume that even though you have given wrong answer, but you have understood my explanation. You have understood my explanation. This was example number 3. Now come to example number 4. Example number 4. Correct. This is a question normally they used to ask in CA Inter. Till now this type of question they have never asked in CA Final. Let's see whether you are giving correct answer or not. Debtor, let's say Mr. X, and amount is 10 lakh. There are 2 situations. However, there are 3 situations. Come to case number 1. Case number 1. Check of rupees 10 lakh received after reporting date but before approval of financial statement. But the adjusting, non-adjusting, very simple. I think everyone will give a correct answer only. Adjusting, non-adjusting. So, check of 10 lakh received after 31st March but before approval of financial statement, whether it is an adjusting event or non-adjusting event. Super easy. Non-adjusting event. I think no explanation required. No explanation required for this. Non-adjusting event, because of course, can I say, we always record a transaction as per their happening. So if the check is corrected after 31st March, we reduce data after 31st March only. Okay, in this no doubt. But that will come in case number 2. Correct? Check dated on or before 31st March. Check dated on or before 31st March, collected after 31st March. Collected after 31st March. Means the date of check is 31st March or 29th March, but collected after 31st March means in the month of April, but before approval of financial statement. Now say whether it is adjusting, non-adjusting. Means can we adjust? Because the date of check is 31st March or 29th March. So can we adjust and can we reduce data on 31st March? But adjusting, non-adjusting. This type of question ICI used to ask it CA Inter level. Very good. Non-adjusting event. Very good. Excellent. If you are saying non-adjusting, Excellent. Correct. Okay. But now I will have a doubt because you are saying non-adjusting, adjusting for example number, case number 1 or case number 2. Correct. So always whenever you are adding answer, add on case number 1, adjusting, non-adjusting, case number 2, adjusting, non-adjusting, so that I can understand for which you are saying adjusting, non-adjusting. Okay. It is a non-adjusting event. Why? Why? The reason you know. The reason you know. Why? Because even though check was dated 31st March, collected after 31st March means it is under the control of the entity after 31st March. So it cannot be recognized as an asset before 31st March. Correct? Yes, sir. So why? Because check is under the control of entity after 31st March and hence cannot be recognized as an asset on 31st March. Okay, sir. Now, case number 3. One more case number 3. Check dated on or before 31st March, collected by collecting agent of the entity before 31st March, but received by the entity after 31st March. Understood. Now there can be some collecting agent of the entity, for example, bank or any employee, whatever. So it has been collected by the collecting agent of the entity before 31st March, but actually handed over to the entity after 31st March. Now you say it is an adjusting or non-adjusting event. It is an adjusting or non-adjusting event. Very good. It is an adjusting event because now it is under the control of the entity once received by the collecting agent. So they are the authorized person of the entity. So it is under the control of the entity only because it can be deposited into their bank. It can be endorsed by the entity even though it is not received by the entity. Got this point? Very good. It is an adjusting event. Adjusting event. Chalega. Done. So example number 4 done. Coming to example number 5. Now let us move from debtor to any other example. Let us come to inventory. 31st March, date of approval. Now even though we have not done Ind AS 2 inventory, but we know about AS 2 inventory, correct? So I can take the example. So there was inventory and the cost price of the inventory was 100 and NRV of the inventory was 120. What is the meaning of NRV? NRV means estimated selling price minus estimated selling expense. Correct? So NRV is an estimation. So of course, as per Ind AS 2, we'll do valuation at lower. So we'll take cost price or NRB which are lower. But what happened? After 31st March, fire occurred, inventory damage, and now it can be sold at rupees 75 only. But the adjusting, non-adjusting, fast. Adjusting, non-adjusting. Super easy, non-adjusting event because there was no condition on 31st March related to fire. The condition arises after 31st March. Therefore, it is a non-adjusting event. Okay. Come to one more example. Example number 6. 31st March, date of approval, inventory, cost price 100, NRV 80. We will take lower 80, but actually sold at rupees 60. Correct. Means what was the management expectation that it can be sold at rupees 80 but actually sold at rupees 60. Batao, adjusting or non-adjusting event. Adjusting or non-adjusting event. So if you are saying non-adjusting, it is not correct. It is an adjusting event. It is an adjusting event. Try to understand one point. I have already said NRB is an estimation. NRB is an estimation. So what was the expectation of the management? It can be sold at rupees 80, but it was actually sold at rupees 60. So it provides further evidence. It provides evidence of the condition existing on the balance sheet date. Here NRB should not be 80, NRB should be 60, and therefore it will be an adjusting event. It will be an adjusting event. Okay, sir. Got this point? To those who are saying non-adjusting event, I hope you have understood it is an adjusting event and super important from examination point of view. This becomes CA final level. This becomes CA final level. So whenever there is an estimation, and for that estimation, some more information came before approval of financial statement. Correct now. So of course, we'll take the information, whatever new information came. So whatever new information is coming, that will be considered to adjust that estimated amount. Understood? Got this point? Correct. Once again, try to understand. NRB means what? It is an accounting estimate. As per Ind AS 2, NRB means estimated selling price. Estimated selling price on 31st March, management were expecting that it can be sold at rupees 80, but actually it was sold at rupees 60. Just try to understand. I have not said that some fire occurred after 31st March and because of that reason 80 becomes 60. It means there was a condition existing on 31st March. There was a condition on 31st March. Are you able to understand? And now we have an evidence that NRB is not 80, NRB should be 60, and therefore it will be adjusted, and therefore it will be adjusted. Just try to understand. We are not passing sale journal entry. We'll do adjustment and we'll increase the loss amount. Means now what will be the adjustment? That will compare cost price 100 with NRB what? 60, and now the lower will be what? 60, and we recognize the loss of 40. We recognize the loss of 40. Understood this point? Have you understood? Respond fast. Respond fast. Once you have understood, just say me yes or no. Understood? Come to one more example. This is also an example, a question of CA final level. Example number 7. And lot of doubt come in this. Let me explain here only. 31st March, date of approval, inventory, the cost price 100. Now, try to understand what have actually happened. Suppose you are a dealer. You are a dealer of electronic items. Correct? It can be any mobile or any electronic item, and you know about all that technology, invention, etc. Because you are the dealer, you are the businessman on that particular item. So you know you should be aware about any market fluctuation or not. And normally just try to understand if suppose there are such type of item, so normally there will be a lot of market fluctuation. Because if new technology came, of course the price of the old model will decline. Are you able to understand what I am saying? So there can be a lot of market fluctuation. Are you able to understand? So it is quite possible due to market fluctuation. Due to market fluctuation, now due to market fluctuation, the market price become 80. Quite possible or not? Due to market fluctuation, the price become 80. Are you able to understand? My question to you all, if this will be an adjusting event or non-adjusting event? Have you understood whatever I am saying? Due to market fluctuation. Now, question has not informed you that if market fluctuation was on 31st March. They will say after 31st March, due to market fluctuation, the price declined to rupees 80. But can I say, as a businessman, you should know about this market fluctuation or not? And if you are not aware about this market fluctuation, so why you are doing in this business? Try to understand. I mean, right now, just try to understand if ICA has proposed a new syllabus, and new syllabus will come after 2 years. So I should be aware about this or not? Because I am into this business. So if I have any old study material, so of course that old study material, it will be now amended. So the price of old study material will be dropped, will be declined, because of course that will become obsolete. That will become obsolete. So I should be aware about these facts and information or not? Yes. And therefore, from your point of view, it should be an adjusting event or non-adjusting event. Adjusting event. Very good. I hope you are understanding my emotion. So this will be an adjusting event. Adjusting event as changes in market is a condition existing on reporting date. Understood? And therefore, the NRB, whatever NRB should be based on this market fluctuation if that happened before approval of financial statement. If that happened before approval of financial statement, are you able to understand? Correct. Now, NRB means what? Estimated selling price. So, of course, if you know that market fluctuation, due to market fluctuation, the price now become 80 before approval of financial statement, it means it can be sold at rupees 80. It means it can be sold at rupees 80, and therefore it will be an adjusting event. Therefore, it will be an adjusting event. Example number 7, you understood. Now, if I say example number 8, try to understand this point. Similar example. Now you will be confused. Now suppose you purchase equity shares of Reliance Industry Limited and the cost price is equal to 100. Now, equity shares of Reliance Industry Limited is actually means you have purchased, means it is an investment. So it is an investment. This is not your inventory. Investment. So it become a financial asset. It become a financial asset. And financial asset is covered under Ind AS 109. Ind AS 109, and it is measured at fair value. It is measured at fair value at each reporting date. It is measured fair value. Just try to understand. Now it is not cost price or fair value, whichever lower. Now it is fair value. And there is a difference between NRV and fair value. NRV and fair value. Are you getting? NRV means estimated selling price. At what price it can be sold. But fair value means fair value on reporting date. So it means it need to be recorded at fair value on the reporting date. Fair value on reporting date. And let's say the market price of these, let's say market price on these is 120. But quite possible, due to market fluctuation, quite possible. Subsequent to reporting date, now the market price become 80. But the adjusting, non-adjusting. Now it become adjusting or non-adjusting. It become a adjusting or non-adjusting. Everyone fast. Very good. If you are saying non-adjusting means you have understood, because this will measure at fair value on reporting date. Therefore, subsequent changes is not at all relevant. But NRV means estimated selling price, at what price it can be sold. But you can see here we measured fair value reporting date, means subsequent changes is not at all relevant. Not at all relevant. So if subsequently the price drop, that is not any, that will not give rise to any condition existing on the balance sheet date, because this is a condition arises after balance sheet date, and therefore it becomes a non-adjusting event. Non-adjusting event. Okay, sir. Okay, sir. Coming to example number 9. I hope you are feeling happy. How you are feeling? Just can you respond me fast? Whether you are feeling good or not. How you are you liking this type of example? Just try to understand. I could have said adjusting, non-adjusting, give some example. Orally you said okay, maja aa raha hai. But try to understand the implication of this chapter. This chapter can be dangerous from examination point of view if you don't know the concept behind this. How you are feeling? Now coming to example number 9. Example number 9. Let us come to property, plant and equipment. 31st March, date of approval. Date of approval. Now suppose you have a machinery. Cost price is equal to 10 lakh. Correct? Means I should not write down cost price. I should write down carrying amount. Carrying amount means after depreciation. And this machinery was sold at rupees 8 lakh after 31st March, before approval of financial statement. Adjusting, non-adjusting? Of course non-adjusting. Correct na? Of course non-adjusting. It is a non-adjusting event. Non-adjusting event, because for PP we never measure at carrying amount or NRV which are lower. Correct? So for PP always will go for cost model, revaluation model coming soon in your life. So can you see it is measured at cost price, cost model, cost model or revaluation model coming soon. Understood? So this event which arises after balance sheet date is a non-adjusting event because it relates to the condition existing after balance sheet date. Coming to one more example. In this you will be confused. And you will be confused because of CA Inter. First let me give one example, and this is very popular question in CA Inter. It is a very popular question CA Inter. Let me first ask you, then I will come to the conclusion. 31st March. Suppose you have a land whose cost price is 10 lakh, 10 lakh, and before 31st March, there was an agreement to sell. Already agreement is already agreed. Agreement to sell at rupees 8 lakh. This is the date of approval. I am giving you two cases. Case 1, registration. Registration means what? Once the land is sold, so it need to be registered with the government. Means that there should be the transfer of name. So we call it registration. Correct now? Registration is completed before date of approval. And case number 2, registration is completed after date of approval. So from your point of view, case 1, case 2, what should be the possible answer? Fast. देखो, I am getting mixed answer. And from my point of view, whoever is giving correct answer, they have taken my class only. From my point of view. If you are giving correct answer, so I think you have taken somewhere my class. Because I was not expecting correct answer. How many of you already taken my class previously and now joining this class again? Because I was actually not expecting correct answer, but some of you have given correct answer. Now just try to understand. Now I'll just explain it. Now you need to change your answer. Let's see how many of you are correcting your viewpoint after my explanation. Whenever there is an agreement to sell, it is already agreed. Already agreed. So if you have done agreement to sale, it means control is transferred. Control is transferred. I will say in most of the cases, once there is an agreement to sale, control will be transferred. Because it is now agreed. Understood. In rare circumstances, if the agreement is subject to some condition, then control might not be transferred. But just try to understand, if the question is silent and they say the question says that it is already agreed, agreement done, and the question is silent, what do you think? Control transferred, control not transferred, control transferred only, control transferred. Now as per India 16, India 16 as well as AS 10 in C enter, both are same. Property, plant and equipment will be derecognized on the date when control is transferred to the buyer. To the buyer. Correct. And can you see this registration is only a legal formality. Legal formality. So as per substance of a form, substance over form, where this legal formality should be observed. No, control transferred, and can you say we should pass the journal entry of sale. So actually I will say it is not a question of Ind AS 10. It is a question of Ind AS 16. Got this point? But this type of questions CA inter level they are asking under AS4, and therefore a lot of doubt will come at CA final level if you are not conceptually strong. From my point of view, registration is not at all relevant. Control transferred. We should de-recognize PP even though registration is not completed. Understood? So I will say if this question came, both cases, correct, both cases, it will be an adjusting event. Because registration is a mere formality. Are you getting? Or I will say it is not a question of Ind AS 10, it is a question of Ind AS 16. Correct? Just write down. Write down. This case is actually accounted as per Ind AS 16, not as per Ind AS 10. However, from exam point of view, from exam POV means point of view. POV means point of view. Both are adjusting event. Both are adjusting event. Understood? Happy now? Both are adjusting event. Let me take one more to understand whether you have understood or not. 31st March, date of approval. There was a land whose cost price is 10 lakh. Cost price is 10 lakh. Now, before 31st March, it was proposed to sell at rupees 8 lakh. Now, it is proposed to sell, and before 31st March, and before approval of financial statement, it was actually sold and registration completed. बताओ, adjusting, non-adjusting. It is an adjusting or non-adjusting event. Proposed to sell. Now I have given the word proposed. What do you think? Of course, now you are understanding my emotions. It is a non-adjusting event. It is a non-adjusting adjusting event, because proposal does not mean control has been transferred. The control is transferred after 31st March. However, just write down for your understanding. However, PP may be classified as held for sale as per Ind AS 105. As per Ind AS 105. Just write down and leave it. Because till now we don't know about Ind AS 105. And right now I don't want to explain Ind AS 105. But once Ind AS 105 will be covered, and when you revise this particular point, you will be able to understand, yes, Ind AS 105 might be attracted. And if Ind AS 105 is attracted, then we have to do measurement as per the requirement of Ind AS 105. Okay, sir. Happy? Come to example number 12. Example number 12. March 31st, date of approval. Suppose there is some legal case pending. So of course you will apply Ind AS 37. We have done Ind AS 37 on 31st March, and based on the best estimate, you have recognized a provision of 10 lakh. But what happened before approval of financial instrument? Case was decided. Now there can be two situations. Situation 1, situation 2. Case was decided against the company, or case was decided in favor of the company. If it was decided against the company, so compensation payable was actually 15 lakh, or it can be 7 lakh, or if it is decided in favor of the company, so compensation payable will be nil. Batao. In this case, situation 1 will be adjusting or non-adjusting. Situation 2 will be adjusting or non-adjusting. Fast. Fast. Of course, sir, both are adjusting. Both are adjusting event. Both are adjusting event because it relate to the condition existing on the balance sheet date. In situation number 1, you need to change the amount of provision, either increase or decrease the amount of provision. In situation number 2, you need to reverse the amount of provision because it is no longer required. It is no longer required. Understood? Example number, try to understand. Example number, this is interesting. Example number 13. Example number 13. Correct. 31st March, date of approval. Date of approval. Now, there was a legal case pending, and right now it was a possible obligation. Understood? And therefore you have disclosed a contingent liability of 8 lakh. Correct? Understood? Now, before approval of financial statement, as per new information, as per new information, measurement should be 15 lakh, not 8 lakh. Quite possible. But just try to understand, this is actually disclosed in notes to account. Notes to account. Are you getting? My question to you are adjusting, not adjusting. Adjusting, non adjusting. बताओ. Now, just try to understand one thing. If I am saying this was actually disclosed at 8 lakh and some new information came, it should not be 8 lakh, it should be 15 lakh. So, of course, it should be adjusted. So, adjustment does not mean only by way of journal entry. If disclosure also require adjustment, it will be an adjusting event. So, this will be also adjusting event. Understood? And we should actually adjust the amount of disclosure, and you should adjust the amount in notes to account. So it will be an adjusting event. Understood? Got this point? Correct. So you can't say non-adjusting event. I was expecting that you will say non-adjusting event, because when we say adjusting event, you always think about journal entry. No, if you need to update the notes to account due to some new information, that is also an adjusting event. Okay, sir. Chalega. I think more or less you are able to understand. Let me take one more last example before I take a very good example. Example number 14. 31st March and date of approval. Suppose legal case is pending, and as per India's 37 already you have recognized a provision of 10 lakh. Now before approval of financial statement, similar case were decided in favor of company. Similar case means either now there will be possible obligation or remote obligation. Got this point? Because it is in favor of company. So either it will become possible obligation or remote obligation. Understood? So in this case, if it become possible obligation, then it is no longer a provision we need to disclose but contingent liability. And if it become remote obligation, no treatment required. So therefore, this will be also an adjusting event. Adjusting event. Understood? Adjusting event. If it become possible obligation, so no more provision required, reverse it and disclose contingent liability. If it become remote obligation, so no recognition, no provision, no contingent liability, no treatment. I hope that also you understood. Chalega. Okay. What is your doubt? Now, it was a contingent liability. Why you are writing contingent asset? I have not understood your doubt. Okay. Now come to a very good question I will create for you. If you can answer this, means from my point of view, I've understood India's 37 as well as India's 10. So I am trying to link India's 37 with India's 10. And this is final level question. Okay. Now this is 31st March and this is date of approval. Now before 31st March, entity decided to close down one factory. Means it is a case of restructuring. And before 31st March, they have already made a detailed plan for restructuring. And after 31st March, before approval of financial statement, they have made announcement of the features of restructuring to the person affected by it. Understood India's 37 restructuring. There must be constructive obligation on 31st March, and for that two conditions need to be satisfied. Entity has made detailed form of plan, and either they have started to implement such plan or made announcement of such plan to the person affected by it. You remember that? So based on that, I have created one question. Now you will say whether it is an adjusting event or non-adjusting event. Adjusting or non-adjusting? Yes, Ray, understood. For remote obligation, reverse the provision now. You want me to write down? Are in the like, if you behave like this, तो मजा नहीं आता. Write down. If possible, then reverse provision and disclose contingent liability. If remote, reverse provision and then no treatment. Understood? Okay. चलेगा. Now, example of 15, what do you think? Adjusting, non-adjusting? If you are giving correct answer, means you have understood India's 37 as well as India's 10. If you are not giving correct answer, means somewhere lack of concept, means you have not done the revision. So correct answer it is non-adjusting event. Just try to understand what I have said under India's 37. There must be constructive obligation for restructuring. For that, both the conditions need to be satisfied on 31st March. Means constructive obligation will arise if both the conditions satisfied on 31st March. But here announcement was done after 31st March, means constructive obligation arises after 31st March, means it related to the condition arising after 31st March, and they have a non-adjusting event. Correct now. As constructive obligation arises after 31st March, and therefore it is a non-adjusting event. Means apply concept. If you will not apply concept, whatever we have done, then you will do mistake. So you need to first apply India's 37. Yes, constructive obligation will arise on 31st March. If both the condition is satisfied on 31st March, then only they are committed. So here commitment actually came after 31st March, and therefore it is not a adjusting event. Understood? Have you understood? Got this? Any doubt? So you can see I have taken 15 example. 15 example. Most of the example I have taken. Now, of course, can I say do all the question of what question bank for better understanding. Now I have done my job. Now your job is what all the question you do by your own today only. Once you do all the question, trust me, you will become expert. Means you will get all the clarity. I mean, right now I will take the question. Now you will not be able to understand. So all the case study is given. Just read it. Apply your common sense. Apply your concept. And if your answer is wrong, don't worry. Write down the fact why you have given wrong answer, why, what mistake you have done. If you are writing that now, yes, this I have thought, but actually this is a concept, then better understanding will come. Don't be relaxed even if suppose you have understood by reading the solution. If you are understanding by reading the solution, it does not mean you have understood. You need to find out why you have given wrong answer and why this answer is as per ICI. Got this point? Chalega? Yes, sir. Now let us come to the India Saaransh book. Examples of adjusting event. Examples of non-adjusting event. Most of the example I have taken, I am just reading. The settlement of a court case after the reporting period. I have taken one example. The bankruptcy of customer that occur after reporting period. I have taken one example for that. The sale of inventory after reporting period may give evidence about the NRV at the end of reporting period. I have taken one example. The determination after reporting period of the amount of profit sharing or bonus payment. Of course, can I say bonus is always based on profit. Profit is known after approval, means on the date of approval. So of course it is always an adjusting event. The discovery of fraud or error that show that financial statements are incorrect. The fraud or error, actually I will take means even the fraud or error, if it is after 31st March and before approval of financial statement identified, means any fraud or error identified after 31st March before approval of financial statement, of course it is an adjusting event. But I will discuss this in detail under India 8 coming soon. I will take one example and relate with India 10 under India 8. Okay, sir. I hope even though I have not discussed, you have understood, because of course, can I say, if any error has been identified after 31st March before approval of financial statement, it need to be rectified. It need to be rectified now. Yes, sir. The determination after reporting period of the cost of asset purchase or the proceed, sorry, the determination after reporting period of the cost of asset purchase or the proceed from the asset sold before the end of reporting period. Just try to understand sometime what happened. Any purchase has been done before 31st March. Any sale has been done before 31st March. But we are not able to identify what is the cost. We are not able to identify what is the sale. For that, some information came after 31st March before approval of financial statement. So of course, that also require adjustment. That also require adjustment. Charega. Yes, sir. Then examples of non-adjusting event, decline in the market value of investment. I have taken one example. Major business combination. Any business combination which is after 31st March will be always a non-adjusting event. Announcement of plan to discontinue operation. I mean, last example I have taken. Major purchase of asset. If you are purchasing any asset after 31st March, it is a non-adjusting event only. Classification of non-current asset as held for sale after reporting date. I have already informed you that this is actually I will discuss under Ind AS 105. So right now I can't discuss. Okay. So right now refer Ind AS 105. I'll come back to this particular example when I will do Ind AS 105. Changes in foreign exchange rate. Of course, if there is any changes in foreign exchange rate, that is always what subsequent changes, and that is does not relate to any condition existing on reporting date. Major litigation. Any litigation which arises after 31st March, not settlement. Litigation arises after 31st March, that will be always a non-adjusting event. You can see these are the questions you are supposed to do right now, not right now, today only. Chalega? Yes, sir. Now there are actually three special case. Three special case. If I cover these three special case, the chapter is over. The chapter is over. We'll take a small break. After break, we'll continue the chapter and we'll cover it. Okay, sir? Yes, sir. Now, now, chali. Can we start once again, everyone? Are you all ready? Chalo. Now, so before break, we completed adjusting, non-adjusting, even a lot of examples we have taken. I hope you have understood. Still, if you have any doubt, you can ask in our WhatsApp group, doubt group, not in any other group. Already we have given you the link of what doubt group. Any doubt should be asked in that group. Okay, no other group. I will not entertain any doubt in any other group. Okay, sir? Yes, sir. Now there are three special case long-term borrowing. The first. However, this particular para is now amended. Due to amendment under Ind AS 1. So if you have some old book, then it is quite possible whatever has been mentioned there, that might be what? Different than whatever I am teaching you right now. So don't follow that, follow whatever I am saying. The detailed discussion about this, I mean right now I am discussing and I hope you will be able to understand whatever I am saying. But detailed discussion of this will be done under Ind AS 1 again. Okay, sir. Now what is this case? We are doing a special case, point number A. Point number A, long-term borrowing. Long-term borrowing. Now, try to understand whatever I am saying. This is 31st March and this is the date of approval. Now, suppose you have some bank loan for 5 years. Understood? And as per the covenant means as per the terms and conditions of the bank. Correct? There was some covenant and actually you have breached that covenant. Covenant means condition, means there is a breach of condition. So there is a breach of covenant. Covenant means what? Condition. It can be any condition. It can be any condition. For example, bank has asked you to contribute the same amount of loan in a deposit, whatever, and that you fail to contribute. Or bank has asked you to what? Submit quarterly report of your financial result, but you have not submitted the quarterly report of the financial result. It can be also one type of breach. So breach happened on or before 31st March. And once the breach happened, this bank loan will be now repayable on demand. Repayable on demand. Understood? Means now bank can demand at any point of time, I need to pay. And once it become repayable on demand, it will be classified as current liability. It will be classified as current liability. Now why current liability? So you need to refer Ind AS 1. I will not discuss why, means what is the definition of current liability. That detailed discussion will do under Ind AS 1. Means from non-current liability it become current liability. Initially it was non-current liability. initially it was non-current liability. Correct. Understood. Now what happened before approval of financial statement, means after 31st March, before approval of financial statement, bank agreed not to demand not to demand as a consequences of breach. Bank agreed not to demand as a consequences of breach, means bank agreed that will not demand, don't worry. Correct. Now the question is that it will be current liability or non-current liability as on 31st March, means adjusting or non-adjusting when. If you are saying adjusting, then it become non-current, because now you are saying it is not current, it become non-current. If you are saying non-adjusting, so on 31st March it will be current liability. What do you think? Adjusting, non-adjusting? Adjusting, non-adjusting? Apply your common sense, huh? Apply your common sense, means whatever we have discussed about adjusting, non-adjusting event. Everyone saying adjusting event, so this is actually before amendment. Now after amendment, it is non-adjusting event. Non-adjusting event. Now try to understand why it is non-adjusting event. Because on 31st March, it is a current liability. On 31st March, it is a repayable in demand. And this condition arises after balance sheet date. So this relate to the condition arising after balance sheet date. Bank agreed not to demand. So bank agreed not to demand. So this condition arises after balance sheet date or before balance sheet date. After balance sheet date, so how can you say it is an adjusting event? How can you say it is an adjusting event? Understood. Now before amendment, just try before amendment. Now you are not supposed to listen about before amendment. After amendment, your answer is non-adjusting event. Khatam. Correct. Now before amendment, as per Ind AS 1, I'm just writing, I will delete it. It was non-adjusting. Not. As per Ind AS 10. And as per IAS 10, International Accounting Standard, what I am saying. As per Ind AS 10, it was an adjusting event, and as per IAS 10, it was a non-adjusting event. So it was a carve out. It was a carve out. You remember carve out? But now this carve out has been removed. This carve out has been removed because now it is at part to what? International Accounting Standard. It is a non-adjusting event. Just try to understand condition. Agreement arises after balance date. So it relates to the condition arising after balance date, and therefore it is a non-adjusting event. It is a non-adjusting event. I think no doubt should come. Correct? Hence it will be classified as current liability on 31st March. Now, a lot of doubt will come if you have done initially adjusting, now non-adjusting. But that doubt will be removed only once I will take the amendment under Ind AS 1. So, if there is a doubt, you are not supposed to ask me right now. Right on refer Ind AS 1. I will take it in a detailed explanation under Ind AS 1. Chalega? Understood? Now, let us come. When an entity breach any covenant of a long-term arrangement on or before the end of reporting period, with the effect that liability become payable on demand, current liability on reporting date. The agreement by the lender, means bank, after the reporting date but before approval of financial statement, not to demand payment as a consequence of the breach, shall be considered as non-adjusting event. In other words, such loan shall be classified as current liability. Chalega? Very, very important now. Very, very important. Correct. Now, this entire para, you'll automatically understand when I will take Ind AS 1. Just I don't refer Ind AS 1. So, one clarification has been given under Ind AS 10 after the amendment under Ind AS 1. If the following event occur between the end of reporting period and the date of approval of financial statement, this event will be disclosed as a non-adjusting event due to amendment under Ind AS 1. Refinancing on a long-term basis liability classified as current. I will take example under Ind AS 1. Therefore, right now I will not discuss. Rectification of breach of a long-term borrowing arrangement classified as current. Rectification of breach of a long-term arrangement classified as current. This also I will take example under Ind AS 1. The granting by the lender period of grace to rectify breach. This also I will take an example under Ind AS 1. Means all example I will take under Ind AS 1. Right now I can't discuss because for that I need to explain the definition of current liability. I don't want to go into that right now. Settlement of liability classified as non-current. Let me take settlement of liability. This is the very simple settlement of liability. Correct now. Means if there is a 31st March and there is a bank loan of 5 years, so it is a non-current liability and is settled before 31st March. Before 31st March and after 31st March and before approval of financial statement. So it is a non-adjusting event only. So if there is a bank loan which is non-current liability, it is settled after 31st March before approval of financial statement. It means it is not an adjusting event. It is a non-adjusting event and it will be classified as non-current liability on 31st March only. Chalega? Yes sir. Yes sir. So settlement of liability classified as non-current will be a non-adjusting event. Chalega. Only this much right now. If any doubt is coming, keep in your pocket because that doubt will be discussed with Ind AS 1. With Ind AS 1. Okay, can I proceed? Now come to next point, going concern. This is the very important point in AS4. I think you remember. Let us discuss going concern. Now what is the meaning of going concern? What is the meaning of going concern? We all know that we prepare a financial statement based on going concern assumption. Going concern means entity has no intention to liquidate. Correct now. Entity has no intention to liquidate, or can I say close down in the near future. We can say there is no intention to liquidate. There is no intention to liquidate, and therefore we do our accounting treatment as per going concern. As per going concern. Okay. Now this is 31st March. This is date of approval. Correct. And a fire occurred. Fire occurred. Correct. And use loss. Use loss. But the adjusting or non-adjusting? What do you think? Fire occurred. There is a use loss. Use loss. So it will be an adjusting event, non-adjusting event. What do you think? Fire occurred in the premises of entity only. And let's say I am adding it was not insured also. Not insured. What do you think? Adjusting, non-adjusting? No, no. If you are saying adjusting means you have not understood. Correct now. Means you are not able to understand my emotions. I said fire occurred whether it relate to the condition existing on the balance sheet date. No. So how can you say adjusting event? So there can be two situations here. Two situations. What our India state says that if going concern remain valid, then it is a non-adjusting event. and no adjustment required. Only disclosure required if the amount of loss is material. But if the going concern become invalid, then it become adjusting event. And as per India's 10, as per AS4, what they want to say now, the financial statement will be prepared as per non-going concern. As per non-going concern means this financial statement, even though in this year it was going concern, but this financial statement will be redrafted as non-going concern. Redrafted as non-going concern means now all the assets and liabilities, all the assets and liability will be recognized at realizable value. At realizable value. Understood? Got this point? Are you getting? It means just try to understand, if you have become non-going concern. So if you are preparing a financial statement as per going concern, means you are not providing correct information to the user of financial statement. Even though in this year you are going concern. So what our India stance says, now you need to present your financial statement as if you become non-going concern, and you need to redraft your entire financial statement on liquidation basis. On liquidation basis. Chalega, I think clear. No explanation required. So what they are saying? Entities shall not prepare financial statement as per going concern if it intend to liquidate or intend to cease trading, or it has no realistic alternative but to liquidate. There is no other option. There is only one option available, that is liquidate. For example, government has put restriction on certain industry. So even though they do not want to liquidate, but there is no option. There is only one option to liquidate. Chalega. So entities shall not prepare financial statement as per going concern if they have intention to liquidate, if they have intention to cease trading, if they have no realistic alternative but to liquidate. If the going concern assumption is not appropriate, that is become invalid after reporting date but before approval of financial statement. Indians then require a fundamental change in the basis of accounting. Fundamental change in the basis of accounting. Because just try to understand, whenever we are preparing our financial statement based on going concern, so we prepare financial statement as per the requirement of Indians. So now we need to actually make a fundamental change in the basis of accounting. So how can we change? Which accounting policy we follow? So actually this is not as per any Indians. Indians is totally silent. Indians is totally silent about what? Fundamental change means what accounting policy now we should adopt. For that, Indians is actually silent, because all the Indians is designed for going concern assumption. Got this point? So a fundamental changes in the basis of accounting rather than adjustment to the financial statement. AS4 used to say adjustment, but India's stance says we should make a fundamental change in the basis of accounting as per our conceptual framework. That is, as per conceptual framework. This is actually our chapter number 1. Chapter number 1. Chapter number 1 I will do at the end. So when I will take chapter number 1, in that I will take one question, how to prepare financial statement for a non-going concern entity. Got this point? So how to prepare financial statement for entity which become non-going concern, we'll discuss under chapter number 1. I mean, not right now, because that is not as per India's 10. India's 10 only says we should make a fundamental changes in the basis of accounting. India's 1 require means now India's 1 requires some disclosure requirement. India's 1 require following disclosure is required if financial statement are not prepared as per going concern. The fact that we are now a non-going concern. Basis of preparing financial statement, at what basis you are preparing financial statement? So you should mention assets and liability are recorded realizable value. or reason why it is not recorded as a going concern. What is the reason that now it become non-going concern? That should be disclosed, but this disclosure is as per Ind AS 1, not as per Ind AS 10. Chalega. Ind AS 10 only says we should make a fundamental changes in the basis of accounting. Okay. No. If use loss is there, it does not mean it become non-going. It does not mean it become non-going concern. Try to understand. That will be the decision taken by the management. If you are saying if I have given use loss, it does not means the going concern is affected. Use less, then also we can recover it. Correct now. We can take loan from the bank and we may decide to what? Continue. To use loss does not mean we become non-going concern. Got this point? I hope you are understanding. If the question is silent, you should give both the answer. If the question is silent, you should give both the answer. Suppose the question came, fire occurred, use loss, nothing has been mentioned, then you should give your both opinion. If going concern become valid, this is the answer. If the going concern remain valid, means if it become valid or invalid, then both the answers should be given. Chalega? Understood? Yes, sir. I think clear. From my point of view, I have done my job. Even after reporting date, whenever there is an even after reporting date, if the going concern is not valid, adjusting event, fundamental changes in the basis of account is required, disclosure is required as per Ind AS 1. But if the going concern remain valid, non-adjusting event, disclosure required if the amount is material. Then coming to last point, proposed dividend. The proposed dividend, I hope you all know that it is a non-adjusting event. It is a non-adjusting event. Correct? I think no explanation required. Because when I say proposed dividend, there is no obligation to pay. So if there is no obligation to pay, there is no question of any liability, and therefore no liability will be recognized in the financial statement. Even the proposal, whatever has been done, relate to the what? Concerned financial year. I hope you understood. So what Ind AS 10 says, if any entity declare any dividend to the holder of equity instrument. Now what is equity instrument? Now equity instrument is a wider term. It will include equity share capital as well as any other instrument which has been classified as equity. Correct? So equity instrument will include equity share capital. It may also include irredeemable preference share capital also. So equity instrument does not mean only equity share. So we'll understand the meaning of equity instrument under Ind AS 32. Just write down refer Ind AS 32. Refer Ind AS 32. Okay. Chalega. So if any entity declare dividend to the holder of equity instrument after reporting date, the entity shall not recognize it as a liability at the end of reporting period. It will not be a liability because there is no obligation to pay. There is no obligation to pay. However, such dividends are disclosed in the notes to account as per the requirement of Ind AS 1. Ind AS 1 says that if any dividend has been declared after reporting date, that amount should be disclosed in the notes to account. But that is as per Ind AS 1. As per Ind AS 1. Understood? My question to you all, everyone, proposed dividend require disclosure as per Ind AS 1. This proposed dividend will be disclosed as contingent liability, or it will be disclosed not as a contingent liability. Means proposed dividend is a contingent liability or it is not a contingent liability. My question is this. Proposed dividend is a contingent liability or it is not a contingent liability? Very good. It is not a contingent liability because when I say disclose to a student, think that it should be disclosed as a contingent liability. There is no obligation. If there is no obligation, the question of provision, the question of contingent liability will not arise. Not a contingent liability. I think in this no discussion required. I hope you have understood. Chalega? Okay, sir. Any doubt? Means can I say in this way? If I just explain you thoda sa, even though explanation not required, but as a teacher now we always think let us discuss only. So this is what our financial year 1/4/2025, 31st March 2026. Okay. Now this is date of approval. This is AGM. This is date of approval. Suppose this is AGM, annual general meeting. And on board of directors meeting, this is the board of directors meeting, dividend is proposed. Proposed dividend. Correct? So for this, no journal entry. No journal entry. But in AGM now, it is approved by shareholders. So it is approved by shareholders. So once it is approved by shareholder, we say it is declared. It is declared. Once it declared, we say it become final now. Final dividend. It become final dividend. So once it become final dividend, will pass one journal entry. Retained earning. Retained earning account debit to dividend payable. So it become liability only once it is approved by shareholders in AGM and it become final. Dividend payable. And within 30 days as per Companies Act it need to be paid. So once it is paid, will pass journal entry. Dividend payable account debit to bank. Correct? So this dividend is distribution to owner. So any distribution to owner is not an expense. Any distribution to owner is not an expense. Hence will not be debited. Hence will not be debited to PL. Not debited to PL. Understood? चलेगा? Clear? थोड़ा सा for your better understanding. Okay. Okay. Now come to disclosure requirement. Disclosure requirement is very simple. Now as by India's 10, we should disclose date of approval of financial statement, who has given approval, and entity's owner or other who has a power to amend financial statement after issue. So I said now there may be some power given to the officer or owner of the company to reopen the books of account. So if that power has been given, then their name is also required. This disclosure was not required in AS4 but required in India's 10. Updating disclosure about condition. Updating disclosure about condition. Existing reporting date for adjusting event. I have taken one example of contingent liability and I said adjust the amount of disclosure that they are saying. Updating disclosure about condition, existing reporting date for adjusting events. Example already I have taken. For non-adjusting event, if the amount is met, following disclosures are required. Nature of event, an estimate of financial effect, if it can be estimate of financial effect. If cannot be estimated, fact must be disclosed that we are not able to estimate it. Chalega. Very simple disclosure requirement. Correct. Chapter is over, but there is one special point. What? Distribution of non-cash asset to the owner. Distribution of non-cash asset to the owner. Holder of equity instrument. Appendix A to Ind AS 10. So what is this Appendix A to Ind AS 10? I need to explain. But Ind AS 10 is over. Ind AS 10 and Appendix A to Ind AS 10 are two different title, different subject. Okay, so Ind AS 10 is completed. Now we are doing Appendix A to Ind AS 10. What is Appendix? Let me explain. Correct. Right. Just try to understand. Internationally, I already informed you that before 2001, there was IAS committee, and after 2001 there is an IFRS committee. That you understood? Now just try to understand, even though there was some international accounting standard or IFRS, there may be some accounting transaction for which IAS or IFRS may be silent. Therefore, this committee used to give some interpretation. So the committee which used to give interpretation for that particular transaction event, before 2001, we used to call it SIC. This is Standard International Committee. Sorry, Standard Interpretation Committee. And after 2001, it became IFRIC, International Financial Reporting Interpretation Committee. International Financial Reporting Interpretation Committee. Now they used to give interpretation. For the transaction event for which IFRS or IAS was silent. So now under Ind AS, this has been added in the relevant Ind AS as an appendix. So now it become appendix under Ind AS. Understood? Means appendix is nothing but interpretation of that transaction for which Ind AS is silent. So appendix are nothing but interpretation of that particular transaction event for which Ind AS is silent. Understood now? Chalega? Yes, sir. So we are doing what? Appendix A to Ind AS 10, and the transaction is what? Distribution of non-cash asset to the owner. Distribution of non-cash asset to the owner. Let me now explain. I require full concentration. Distribution of non-cash asset to owner as per Appendix A to Ind AS 10. It means we are discussing about entity and owner. Owner means equity participant. You can say owner when I say it is nothing but equity. Participants. Now, equity participant means holder of equity instrument. Right now, you can understand from equity shareholders point of view. Okay. So, actually, there are three types of transaction between them. One is contribution from owner. One is contribution from owner. It can be in cash. It can be in non-cash. Anything can be contributed by the owner. Anything can be contributed by owner. And this has been discussed under Ind AS 32. Means contribution to owner, whether contribution from owner, whether in cash or non-cash, already discussed under Ind AS 32. Then point number B, distribution to honor, distribution to honor. It can be also cash, non-cash. So it is dividend only, whether distributed in cash or non-cash. Dividend now, it is dividend. Now just try to understand. Right now I have discussed something about proposed dividend. We have discussed something about proposed dividend. Now proposed dividend will not be recognized will not be recognized. This is as per Ind AS 10. A clarification has been given under Ind AS 10. Will not be recognized in which financial year? In which financial year? 25-25, 25-26. Will not be recognized in 25-26 as per this example. But this journal entry, retained earning account debit, dividend payable, this is as per Ind AS 32. This is as per Ind AS 32. Understood now? Means when I have done the journal entry, return earning account debit, dividend payable, this is as per Ind AS 32. Ind AS 32 says that any distribution to the equity participant will be debited to retain earning, will be debited to equity, will be debited to retain earning. Chalega? Are you getting whatever I am saying? Just say yes sir, I will. थोड़ा सा technical, easy but technical. So can I say this cash wala point, accounting treatment has been given under Ind AS 32, but Ind AS 32 was silent regarding this. This was question mark. Why? Because if anything has been distributed in the form of non-cash, so at what value? How can we find out? That was a doubt. And Ind AS 32 is silent about this. Ind AS 32 is actually silent about this. Point number C. Third one is what? Any other transaction. Any other transaction. Can I say any other transaction can be sale transaction, it can be purchase transaction, it can be loan transaction, as if can I say the owner is any other party. So you can see in A and B it is only one way, but in C it is two way. Two way means try to understand when I am saying other transaction. So if it is a sale transaction, try to understand. If it is a sale transaction by entity to the owner, the owner is receiving what? Goods, and entity will receive what? Cash. So it is two way. So we call it is a reciprocal transaction, and reciprocal transactions will be covered as per respective Ind AS. It will be accounted as per respective Ind AS, as per the nature of transaction. If I am saying loan transaction, so as by Ind AS 109 coming soon in your life, so it will be as per respective Ind AS. Understood? These two are known as non-reciprocal transaction. We call it non-reciprocal transaction. Understood? Understood? Correct. So you can see this was covered under Ind AS. This was covered under Ind AS. Doubt was related to what? Distribution to owner in non-cash. And for that, clarification has been given under Appendix A to Ind AS 10. From my point of view, it should be given under Ind AS 32. I don't understand why they have given this particular clarification under Ind AS 10, because this is about the accounting treatment. Are you getting? From my point of view, the clarification should be given under Ind AS 32. But chalo theek hai, we are not going into that. But I hope you have understood Tora. Chalega. Now, let me explain this particular point with the help of one example. And trust me, you will be able to understand by your own. Trust me. Let me come to one example. Are you ready? Example number 1. Entity proposed distribution of one pen to all shareholders on 15 Jan 2017. So this is a proposal date. Entity declared and approved the dividend for distribution of one pen. Declared means now it is approved to all shareholders on 15th Feb 2017. 15th Feb. So this is the date of approval. It was actually distributed on AGM which was held on 15th Feb. Actually distributed. And you can see in 15th Feb, between 15th Feb and 15th Feb, there is one reporting the 31st March. Fair value, not cost price. Fair value of each pen on 15 Jan was 500, on 15 Feb was 500, on 31st March was 520, and 15 5 it was 515. Just try to understand, fair value of pen will not increase. This is only from this is only for what your understanding. Let us say pen is of what, gold or silver, then the fair value will increase or decrease. Now, are you getting what I am saying? Pen fair value will not increase in 1 or 2 days. Try to understand. But if the pen is of gold or silver, it might increase or decrease. It might increase or decrease. Are you able to follow me? This is fair value. This is fair value. Okay. Yes, sir. Now the fair value, you can say it is market price. It is market price. But fair value and NRV are different. Fair value and NRV are different. Fair value, you can say it is what, market price. Okay. Now we'll do detailed discussion of fair value. No, but not now. But not now. Now cost price of each pen means at what price entity has acquired it, at 400. Let's say this pen are inventories. Let us assume these are inventories. Quite possible. Yes, sir. Number of shareholders 1000. Number of shareholders 1000. Now I will ask you, apply your common sense. What journal entry will do? What journal entry will do? Correct. Now you will say on 15 Jan 2017, what journal entry? Everyone fast. On 15 Jan 2017, what journal entry? Means on the date of proposal. Super easy, no journal entry. Whether you require any clarification, a chartered accountant does not require clarification. Okay, very simple. Means even though if I will not do this appendix, you can do by your own in your exam if you are conceptually strong. Am I right or not? That only I just want to inculcate in your life. Even though you forgotten the concept, behave like a chartered accountant and just attempt that question. Just attempt that question. Most of the time, I will say 60 to 75% time, your answer will be correct. So can I say on 15 Jan 2017, no journal entry? Very good. Now you will say on 15 Feb 2017, when it was declared, what journal entry? What journal entry? First give me journal entry. Amount, then we'll discuss. First give me the journal entry. If you want to write amount also you can write down. I know you will give me correct only. Retained earning, Retain earning account debit to liability means retain earning account debit to dividend payable. Very good. So on 15 Feb 2017, retain earning account debit dividend payable. Now what amount? Can you say as per the fair value of non-cash asset? The fair value of non-cash asset, can you say 1000 shareholders? 1 pen and the fair value is 500 means 5 lakh, 5 lakh. So fair value as on 15 Feb 2017, that will take 5 lakh. Understood this point? Any doubt? Very simple. Now on 31st March, what happened? The fair value has been increased from 500 to 520. So what our appendix say that we will do the adjustment in increase or decrease for increase or decrease in the liability, because from 500 it become 520. Are you able to understand? So we'll increase the liability. What journal entry will do? Retain earning account debit to dividend payable. Retain earning account debit to dividend payable. To retain earning account dividend payable with the amount of 20 into 1000, that is 20,000. Simple. Right. But on the actual distribution date, now it become 515. Once again, we'll do reassessment of liability through retain earning. Now liability decreased by 5,000. What journal entry will do? Dividend payable to retain earning. Dividend payable to retain earning by 5,000. I think no doubt these three journal entry you have understood. Am I right or not? Now we'll do distribution journal entry. Distribution journal entry. Can I say now we should de-recognize our liability and de-recognize our non-cash asset means pain, because pain will be actually distributed. So what journal entry will do? Dividend payable account debit to inventory. Dividend payable will come at 5,15,000. Correct. And can you say to inventory, because inventory will be already, inventory is already recorded at cost price, that is 4 lakh. So it will be de-recognized at their carrying amount. It will be de-recognized at their carrying amount. So what journal entry will do? Dividend payable 5 lakh 15 to inventory 4 lakh. And can you say the difference will be nothing but gain or loss on sale of asset or distribution of asset, not sale, distribution of asset. So this is actually gain or loss on distribution of asset means non-cash asset. So any gain or loss on distribution assets should be transferred to PL, and therefore it will be transferred to PL. Are you getting what I am saying? This gain or loss should be transferred to PL, not to retain earning. Retain earning means what? Distribution, dividend will be debited to retain earning, but any gain or loss on distribution of asset will be transferred to PL. PL, it will affect your PL. This only is a very key point. Ki dividend payable 5,15,000 to inventory 4 lakh, and the difference will be profit, and this profit will be transferred to what? PL account. This profit will be transferred to PL account. Understood? Have you understood? Any doubt? Now, sir, why PL account? Let me explain what is the meaning of income and expense. Income and expense. The meaning of income and expense is given in conceptual framework. Conceptual framework. Chapter number 1. Understood? What is the meaning of income? Income means increase in asset or decrease in liability with a corresponding increase in equity. In simple, what I am writing. So income means what? Increase in asset or decrease in liability with a corresponding increase in equity. And there is one exception. What is an exception? That contribution from honor is not an income. So except contribution from honor. Because when I say contribution from honor, so that will also increase your asset and increase your equity. Cut this point. So it will meet this definition. So they have just given one clarification that except any contribution from equity participant, all will be income. So increase in asset or increase in liability with a corresponding increase in equity other than contribution from equity participant, this is the meaning of income. Similarly, what is the meaning of expense? Decrease in asset or increase in liability with a corresponding decrease in equity But there is also one exception. What is the exception? That distribution to honor is not an expense. So because of this reason, any distribution to honor, whether in cash or in non-cash, will not be transferred to PL. That will be debited retained earning. Understood this point? Have you understood this point? Are you getting the conceptual understanding? I am teaching you from concept point of view, not from rectification point of view. This journal entry you have understood. Now let us come to appendix. You will be able to understand each and every point. Non-applicability of appendix A to Ind AS 10. It is not applicable for accounting treatment in the books of shareholders. So we are doing appendix A for accounting treatment in the books of entity who is distributing, who is receiving. For that, appendix A is not applicable. So in the books of shareholders who receive such distribution is outside the scope of this particular discussion. It is also not applicable distribution of non-cash asset to the entity which is ultimately controlled by same party before and after distribution. Of course, this para right now you have not understood because I will discuss this point under Ind AS 103 coming soon in your life. So second point just ignore right now. Automatically I will discuss under Ind AS 103. Applicability. It applies to the following type of non-reciprocal transaction. Understood? Non-reciprocal transaction between entity and owner, distribution of non-cash asset, or distribution that gives owner an option of non-cash asset or cash alternative. Means distribution of cash is not covered. Distribution of non-cash asset or distribution where the option has been given to the owner whether they can demand cash or non-cash. That is also covered here. Measurement of dividend payable. Entity shall measure dividend payable to its owner at fair value of the asset to be distributed. Understood? If the entity gives this para, I will read afterward. At the end of each reporting period and at the date of settlement, the entity shall review and adjust the carrying amount of dividend payable with any changes in the fair value of asset to be distributed. Understood? When the entity settle the dividend payable, it shall recognize the difference, if any, between the carrying amount of asset distributed and the carrying amount dividend payable in PL. This also you have understood. Accounting treatment, just read down. We have done that only. Chalega? Yes, sir. Only this para. Now, suppose the option has been given. Option has been given. Let me take one example. Option has been given. Correct? So, distribution of non-cash asset and cash alternative. Correct? Understood what I am saying? Now, suppose 15 Jan 2026. Understood? Now, what was it was declared. It was declared on this date. Declared. How many shareholders? 1000 shareholders we have. So, either they can take one pen whose fair value is 500 or they can take cash of rupees 400. Understood? And there is a probability that 60% will demand non-cash and 40% demand will be cash. So in this case, we'll pass one journal entry. Retained earning, account debit to dividend payable. Dividend payable based on the probability. You will say 1000 to 60%, 600 demanded pen worth rupees 500 and 400 demanded cash worth rupees 400. So what is the answer? Answer is what? Batao. 600 into 500, that is 3 lakh, and 400 into 400, that is 1,60,000. It become 4 lakh 60,000. 4,60,000. Now on, suppose I'm not taking about what 31st March. 31st March I'm ignoring. Suppose on 28th Feb 2026, actual distribution. Actual distribution. Now one pen worth rupees 520 and cash will remain 400 only. But now 30% actually demanded pen and 70% availed cash. So now it will change. So now we'll say 300 into 520 plus 700 into 400. Am I right? So 300 into 520, it is 1,56,000 and 7 4 28. So plus 2,80,000. So it becomes 4,36,000. So you need to decrease it. Minus 4,60,000. So 24,000. So what journal entry you will do? Dividend payable account debit to retain earning. How much? 24,000. My amount is correct or not? Just check it now. So this type of question can be asked in MCQ. This type of question can be asked in multiple choice question. This similar question have been already given in the ICA case study digest, but not given in exam, nor given in study material. Understood? Chalega. So any type of question can be asked. Till now they have not asked this type of question in exam, but trust me, they can anytime ask in MCQ. Have you understood this? Correct. Now we can read that point. If an entity gives on a choice of receiving either a non-cash asset or a cash alternative, the entity shall estimate a dividend payable by considering both the fair value of each alternative and the associated probability of owner selecting each alternative. That only we have done probability. That probability will be given the question. Done. Entire chapter is over from my point of view. Now all the questions given in question bank must do. All the question must do. So you can see how many questions are there. It will take, I think, only just go read the question, read the solution if you don't have time, and just identifying whether you are able to understand or not. Must do is what? This is must do. 25 must do. Normally they ask this type of question in exam. 24 must do. Balance, so I think you can do by your own. Every question you can do now. But any doubt, I am there for you. Chalega. Okay. Okay, understood. So today this much only. What is must? Today complete all these questions. Those who have not yet completed India's 37. Trust me, if you are not completing India's 37 right now, then entire all question after 10-20 days will pile up. Accumulation will be there. Then what happened? We feel what heavy. If you do with me, it will take 1 hour or 2 hours to complete the entire questions. Do it. My suggestion, do it. Or do it what? Third category first, then second category, then come to first category. In this order you do. Chalega. Thank you very much. We'll meet tomorrow. Till then, bye bye. Take care. Enjoy your remaining day. Bye bye.